Studies have shown that the average investor tends to underperform the market, not because of what they invest in, but because of how they react to it. And that's not surprising because investing is complicated. There are endless decisions, constant uncertainty, and no way to predict what markets will do next. But in the middle of all that complexity, there's one thing that matters more than most people realize: how well your strategy matches who you are as an investor. And you don't find that out when things are going well, you find out when they're not. And we saw a perfect example of that in 2021, when GameStop became the most talked about stock in the world. This wasn't some breakthrough company. It was a struggling retail business that suddenly started skyrocketing. At first, it climbed steadily, then faster, then it exploded. Social media was everywhere. People were sharing stories of turning a few $1,000s into life-changing money. And that's when most people got interested.
As of this morning, I profited $47,000 in GameStop stock.
Not at the beginning, but in the middle of the surge. Or worse, right near the top. Because at that moment, it didn't feel risky. It felt obvious. Then the momentum slowed. The price started to fall, and just as quickly as it went up, it came down. Now the same people who felt confident buying had to make a decision. Do I stay or do I get out? And that moment right there, that's where risk tolerance shows up. Not when things are going well, but when they're not. Think of it like a roller coaster. Some people love it. Hands up, smiling. Others are gripping the seat, just trying to get through it. Same ride, different experience. Investing works the same way. Two people can own the exact same investment and have completely different outcomes. Because most people build a portfolio that looks good on paper, but doesn't match how they actually feel. And when the market drops, you don't rise to your strategy, you fall to your emotions. Now compare that to Apple. Today it's one of the most valuable companies in the world, but it didn't get there in a straight line. There were periods when the future was uncertain, where confidence was low, and where holding on didn't feel easy. And that's the part people forget, because great investments don't just test your ability to pick them, they test your ability to stick with them. That's the difference. It's not about avoiding volatility, it's about being able to live through it. So before you think about what to invest in, you need to ask a better question. What kind of investor am I, really? When markets drop, do I check my account constantly? Do I feel the urge to do something? Or can I stay patient and let things play out? Because there's no perfect strategy, only the one you can stick with. Because in the end, success in investing isn't about being right, it's about being consistent. And consistency doesn't come from knowing more, it comes from knowing yourself.